Hi guys. Okay, so we are live. Hi everyone. I'm pleased to present and moderate the next panel on how macro investors approach digital assets. My name is Meraud. I run Woorton, leading marketing firm based out of Paris, which traded billions in 2020, making markets for investment firms, exchanges, lending platforms, and so on. And today they are all on the table for this panel to enlighten us on how macro investors approach digital assets. So let's start with a quick intro of our panelists and their position in our ecosystem. We have Dan Morehead, CEO of Pantera Capital, showing the way of macro investments since 2013. Can you please introduce yourself and tell us a bit more about your company, Dan?
Thanks. Yeah, I've spent the first half of my career as a global macro investor. I was last the head of macro at Tiger Management with Julian Robertson in the late 90s. And then in 2003, founded Pantera Capital. We previously managed $1 billion of very normal, opportunistic global macro style hedge funds. But in 2011, I got interested in Bitcoin, and we launched the first crypto fund in the United States in 2013. And we're now seeing quite a number of other institutions get invested in our 4 different products, which span very liquid hedge funds all the way through venture capital investments.
Okay, thanks a lot. We're going to come to some of these guys. Philipp Gradwell, Chief Economist at Chainalysis, leading Chainalysis company in the world. Can you please introduce yourself a bit more about your background and the Chainalysis?
Sure, thanks for the introduction. So Chainalysis is the blockchain analysis company, perhaps best known for providing compliance and investigation software to governments and crypto businesses and financial institutions. But to do that, we have to look at all of the on-chain data. So how people are actually using cryptocurrencies and moving them around. And my job is to look at that data set and to give the big picture view on how Bitcoin is going in and out of exchanges, or how much ETH is going into DeFi, or how much are people actually holding on to the assets as a source of investment. And that's really the perspective I bring on this, the data-driven view of the activity.
Thanks, Philipp. David Olsson from BlockFi, VP for Asia and Europe, if I'm correct. One of the leading lending platform in the world as well. Can you please introduce yourself?
Sure, thanks. Yeah, Charlie, you got it right. So, I'm vice president for Europe and Asia, and also run distribution on our institutional side. BlockFi is a fintech and crypto financing platform. Our retail clients place crypto with us, and we pay a yield on that crypto. And then on the institutional side, we provide financing for your typical institutional investors like hedge funds, prop trading firms, market makers like you, Charlie, and family offices as well.
Indeed, very clear. And last but not least, Uldis, CEO of Globitex and NextPay, one of the most trustworthy banking solutions in the field in Europe. Uldis, your turn.
Yeah, I don't have anything to say after this kind of introduction. Most trustworthy banking provider in Europe. Yeah, that's what we definitely strive to do. So I'm Uldis, and I run Globitex, and what we're trying to achieve is to become the go-to infrastructure provider for banking and liquidity for crypto businesses in Europe. What positions us very well to do that is our relationship with the Bank of Lithuania, which custodies our client funds for us, which ensures us the ability to provide a secure environment for digital assets market participants to transact, custody, and build their businesses upon. So part of the infrastructure ecosystem.
Okay, very clear. I can only testify. So PayPal, Square's Cash App, not to name some of the institutions through Grayscale, over the past weeks have been buying more than 100% of all newly issued Bitcoins. Dan, how do you value Bitcoin in relation to supply and demand, knowing those facts? Dan, you're in mute.
I had a fun conversation with a friend of mine, a Tiger Cub, a few years ago. That's a TMT investor, and he said, "Hey, we don't trade Bitcoin because there's no cash flows to discount. Obviously, there's no cash flows on dollar yen or the euro or the sterling, so you need to use other metrics to value bilateral exchange rates. The simplest one for me is just supply and demand. Bitcoin and other cryptocurrencies have some utility. They're useful for something. Different people like them for different reasons. Some people want to store wealth in them. Some people want to use it to send money across borders. There's hundreds of different use cases. And the more people that use them, the more valuable these currencies become. Bitcoin, as the benchmark for the industry, probably has about 100 million people using it today. 6 or 8 years ago, it was 1 million people. Before that, it was 100,000 people. And each time you increase by an order of magnitude the number of people using it, the price just has to go up because there's a fixed quantity. And when PayPal announced they were going to allow 300 million users to very easily access crypto, that's big news for our industry. It's a lot of people coming into the market. And PayPal doesn't release data on how many of their clients are buying crypto, but we've implied that via using their exchange, an exchange called itBit, at very low and steady volume before PayPal went live. And as soon as PayPal went live, their volumes have gapped up, and they're now, PayPal alone is buying more than 100% of all the newly issued Bitcoin. So if you have somebody buying more than all the supply, the price has to go up to get more sellers from previous holders.
Charlie, I think you're on mute.
Well, sorry, thanks. I was saying Dan showed me the way talking about data that he has been looking at to understand how the inflow coming from PayPal was having an impact on this market. Is it some data that you've been seeing too, even if you're not necessarily analyzing the data of trading on exchange, but more on the blockchain?
Yeah, so it's actually a really similar story to what Dan said if you look on-chain. So we can look at all of the wallets, the sets of addresses that people control, and we can infer the type of holder. For example, we can say, look, this set of wallets, Bitcoin kind of just comes in there and it sits there and they never recirculate it. And that's the typical investor behavior. And if you use that measure, it's actually about 77% of all Bitcoin that hasn't been lost is actually held by investors. And that's only been increasing. And in fact, the growth of that sharply increased after mid-March, which supports the hypothesis that after financial markets sold off across the world, including in Bitcoin, people then turned to Bitcoin as an asset to hold as there was this monetary response from mid-March to deal with COVID. You see growth in that since then, and that's actually more and more investors are buying Bitcoin. And then the Bitcoin that's held by traders, people who have Bitcoin in wallets that will sort of circulate very rapidly, that's actually lower. It's been going down. It's lower than it was in 2017. It's actually as low as it was back in 2015. And so that shows you there's all these investors buying, and there's also just this real shortage of liquid Bitcoin that's not even on exchanges, but it's held by people who typically might sell. And then, as to Dan's point, the price goes up because someone who's self-custodying their Bitcoin, they bought it to hold for a long term. They're only going to send it to, an exchange or send it to a broker if the price is right, which means it's got to really start rising. And that's what we saw in the last few months.
Thanks a lot. I think you gave some of the explanation of this bull market and bull run of the end of 2020. David, how is this bull cycle is more sustainable than 2017, according to you?
Yeah, I think Bitcoin has a little bit lower profile now. It's hard for us to see that inside kind of the bubble of the ecosystem, but certainly with kind of retail, it has a bit lower profile. Although that might change shortly, obviously with PayPal. But during the kind of nuclear winter, when after the Bitcoin kind of crested, peaked, and then came down, a lot of people were working hard in the background to build infrastructure. And I think in terms of security, we're in a much better place than we were in 2017. The number of hacks, the quantity of funds stolen, for example, is a lot lower. Regulated trading venues have proliferated. So you've got CME offering futures and options, and as well as backed. So I think that there's a lot of infrastructure that's being built for institutional investors. Obviously, Fidelity's in the custody space, who's a partner of ours. But so at BlockFi, our mission is to try and bring that, or be part of that institutionalization, and bring that kind of to some of the traditional hedge funds. You know, like Dan before he was converted into crypto. And we're definitely seeing that that trend pick up across a number of ways.
Something I'd just add to that, just to demonstrate how good the infrastructure has got. We had OKX stop withdrawals. We had concerns of a BitMEX when the charges were there. The market shrugged that off. And if that had happened back in 2017, I think we would have seen a much bigger price response. This time round, people were like, okay, there's enough other venues, we'll take it in our stride.
Yeah. Uldis, you are the ones that are working in Europe and most exclusively in Europe. How can European investors make the move into digital assets that we're seeing in the US, and how do you help them about this?
First of all, I'd say that we to add on what others said before. I think that we have a really good coincidence happening this year of a major crisis in the world, kind of opening eyes for a lot of people, and also the infrastructure having grown to a certain level, right? So I think it's a perfect combination, because I think a reasonable question would be, why now, right? People have been talking about the institutional money coming for years, and saying that, oh, just wait until institutional money comes, then you'll see. And I think this year we have really just started to scratch the surface with this combination of a pandemic, of a global turmoil, of a continued printing frenzy, and a divide between the financial markets and the real economy. And at the same time, there are players that have established themselves providing verifiable, regulated, audited services, which is something that was scarce a few years back in 2017 when there was the previous big run-up. So what we do is that we provide such security for the market participants, our clients, handling investments from high net worth individuals, from larger corporates. When they work with a service provider like us, they can be sure that the money that they are keeping with us is not being lent to anybody, is not being invested in any high risk products. It's just sitting there at in the ECB system of central banks, which is, at least so far, still one of the most trustworthy names in the financial markets. So I think solutions like that, and like Gemini in the US, really taking the from day one the approach that we're gonna do crypto right, and we're gonna make it a financial services grade industry. And that's what's happening, and I think we're enjoying the benefits and probably jumping some years ahead with this pandemic.
I think you're right in saying, like, all the macroeconomics dynamics of 2020, and we've seen in the US and in Europe the direction coming from governments and the policy. How does monetary policy affect cryptocurrency according to you?
Yeah, I think, like has been said, that this is an unprecedented global macro impact. The central banks of the world are printing money at rates that literally have never been seen before. The chairman of the Federal Reserve said they would do unlimited money printing. In June, the United States printed more money than in the first 200 years of its existence. So all that money is flooding the system, and it has to increase the price of things whose quantity cannot be eased. Things like gold, things like Bitcoin are going to have to go up in price. Or the other way to say it is the price of paper money has to go down. There's so much being flooded into the markets. The value of the dollar or the euro or the pound sterling is going down at a rapid rate. And you can even see that the best proof of that thesis is the value of the S&P 500 has gone up 14% this year. We're in the middle of an economic crisis. Corporate earnings are down 30%, and the price of equities has gone up. That means there's so much money sloshing around, it's inflating the price of things, or debasing or deflating the value of paper money. And I think we're unfortunately still right in the middle of the economic impact of the crisis. Obviously the vaccine is great news, and that will start changing lives, but it's going to take 2 or 3 more quarters. And then there are a lot of things that are still psychologically damaging, like you're not going to go back into a movie theater for a long, long time. So the economic impact is going to be large, and they're going to keep printing money. In the United States, the Fed has said they're going to double the rate of inflation, which is the first time I've ever heard that in my life, where a central bank is promising to increase inflation. And cutting inflation is very hard. It takes years and institutional buy-in, but creating inflation is very easy. Zimbabwe, Venezuela, they prove it's easy to do. So I think the best asset is a hedge via some kind of fixed quantity thing: gold, Bitcoin, Ethereum, XRP, something like that.
Dan, I'm going to challenge you for a second, if that's okay, on the having fun. Sorry?
I was about to say, what do you think? So you're perfect in time, perfect timing.
Yeah, okay. Yeah, I was just going to say the ECB has failed to create inflation for a long time. They have a target, one mission, which is to create 2% inflation, and they haven't been able to do that. Haven't seen inflation pick up too much in the US. How do you respond to people that, might use that argument?
Yeah, it's a good argument. I would say there's a very, very big difference in the inflation rate of things that can be quantitatively eased and things that cannot. And almost everything in the CPI basket can be eased. The price of flip-flops, the price of flat screen TVs, almost all the things that are measured in normal CPI baskets, which the ECB or the US Fed targets, you can make limitless amounts of them. And with all the slack in the global economy, the price of things like goods and services is not going to go up. However, things that can't be eased, like gold or real estate or shares in the S&P 500 or Bitcoin, those are the ones that are going to see the monetary impact.
And David, you again. Is it the reason why you're seeing more and more institutions getting into crypto and maybe, as you just all said, trying to find the perfect edge against this inflation? Do you think that their investment phase?
Yeah, I think it's definitely reading the headlines. You see that more and more macro investors are buying into the story. Obviously, the first one that came out publicly was Paul Tudor Jones. On the institutional side of our business, we're seeing, at least the number of conversations that we've had with traditional investors, including macro funds, over the last month is more than probably 3 or 4 times all the previous conversations that we've had with similar kinds of investors. So I think just price action alone has, as one hedge fund manager said to me, I said, "Are you following Bitcoin?" I met him for a coffee, and he said, "How can I not?" So, that's sort of woken people up, and now they're at where we sell picks to the miners. So obviously we believe in crypto, but they say, "Do you think it can go further?" And that's not for us to really opine on and all of the kind of demand and supply arguments. But for sure, I think it's hitting on 2 themes. One is in the era of COVID. One is technology and digitalization, and Bitcoin is a part of that. And the second theme is devaluation of local currencies, of fiat currency. So it's hit on if you're in one of those 2 camps, you're doing well. Bitcoin is in both.
And this incoming flow coming from institutionals, Philipp, is it something you can see through analyzing through your data analysis? Like you You look at the Bitcoin blockchain and you can tell me there is more institutional incoming flow.
Yeah, you can. So, for example, this year there's been 20% more $1 million plus withdrawals from exchanges than there was in 2017. And so, yeah, you can see that people essentially are buying in bigger ticket sizes. And that's something that you can't actually see, say, in the exchange trade data, because people will break up their orders. There's also a lot of people that will be trading OTC. And while that's harder to see on chain, you can get a sense of that. And so you see sort of greater activity there. So we can definitely see that there's people buying Bitcoin and then taking it off in like bigger amounts. I actually just wanted to pick up on like David's last point, because I totally agree. There's the technology side and then there's the kind of scarce asset side. I've actually seen like Ethereum almost take more of the technology investment mindshare sort of narrative, and Bitcoin be stronger on the this is a scarce asset narrative. I'm just wondering if people have come across that as well.
Uldis, do you add anything about that?
Clearly, I mean that's the narrative for Bitcoin has changed over the years, and now I think people for a while have landed on the store of value story, while Ethereum is trying to be the platform for innovation and technology, and people who care about innovation more about than wealth preservation, and they are appealed to that. One thing that I have noticed, and maybe others can comment on that, I see a quite big difference in the narrative that is coming from these larger investors, especially differing between the corporate loud ones and the kind of macro investors, fund managers. Like when MicroStrategy, Michael Saylor, went public with their big Bitcoin bet, right? He's captain of the ship and going to go down with the ship, and has become a celebrity on the crypto Twitter, and tweeting every day some philosophical stuff about Bitcoin, going all in. You can see he has personally invested huge amounts. His company has invested huge amounts. He is all in. But when I hear comments from the macro investors, it's more like it's a great play for the next few years. It's you would be stupid not to invest. You would be stupid not to take this opportunity. And I think that's quite a big difference. And I don't know if other panelists have a similar sense and conversations with these kind of guys, that they are kind of more opportunistic in their view, and not seeing Bitcoin as the answer for their portfolios for infinity.
Yeah.
Philipp, I think that's a great point. The very famous global macro investors that have invested recently, we mentioned Paul Jones. We've also had Bill Miller and Stan Druckenmiller. They all buy Bitcoin. They don't buy ETH. They don't buy XRP. They're buying Bitcoin, and they're buying it on a scarce asset. And all three of them have actually compared it to gold. And so it's very clearly global macro investors think there's going to be lots of paper money, and you have to buy gold or the next best thing, which is Bitcoin.
Yeah, well, you just helped me with my next question. I wanted to close the topic of institutional investment by asking you that, can we really say Bitcoin is challenging gold? They really have the same characteristics? Can we put them in competition or so and say, okay, Bitcoin is the next gold?
I think it is. Sometimes people use that as a negative. They say, oh, Bitcoin's just digital gold. It doesn't do anything else. Gold's a $10 trillion market, so that's a big thing to be competing with. And gold's been around for 5,000 years, so it's not going away immediately. But over the next couple decades, the world is going to change, and people are going to realize Bitcoin does everything gold can do, and then it does a lot of things better. So you're going to see Bitcoin eat into gold's market share. As I just mentioned, the global macro investors that have very publicly backed Bitcoin all said it reminds them of gold. Paul Jones said it reminds him of gold in the 70s. I think it's a great analog. That's when we had the first big bout of inflation in the world, and gold performed very well. And one of the thoughts that does occur to me is I could see a world, say 30 years from now, where all central banks have some Bitcoin on their balance sheet, and not all central banks have gold.
Interesting. There is one thing I'm sure institutions don't really understand yet. It's all the lending and borrowing dynamics
Yeah.
that we have been coming up in 2020 with actually questionable rates sometimes, and sometimes very opportunistic rates with good relative spreads. David, I know that's one of the biggest business lines for BlockFi. What do you think about it? What are the dynamics? How this market is structured? How can I explain to an institution that I can pay so much for an over-collateralized loan?
Yes, I mean, sure. I think that's definitely one of the topics that we cover in those kind of first chats when we're describing the crypto ecosystem and how an institutional investor can get financing from BlockFi. And it's really about opportunity costs and a bit of supply demand, because you have Bitcoin futures that trade on the CME. There's a premium. Usually, there's a premium on those futures, and as well as on overseas exchanges. But the dynamic essentially is, if I'm a lender that I have dollars, I can lend to my clients at an interest rate, or I could do what's called the cash and carry trade or basis arbitrage by shorting futures on the CME and buying spot, and then realizing the yield on that premium if I hold them to expiry. So I wouldn't lend necessarily to a client at a lower rate than I could realize through just doing a simple trade with Bitcoin futures, and so that sort of drives the supply demand on the dollar side, as the premium can be from 10 to 20%, and you'll see it shoot up, and then the dollar rates for financing shoot up. And there's two components to the financing rate. There's the funding rate, which is driven by supply demand curves, et cetera, and the futures as I just described, and then there's the credit risk portion. So over collateralization takes care of the credit risk, but it doesn't take care of the pure funding rate. I think so when investors come to borrow Bitcoin, if they want to use it for inventory, to short, or use as collateral in overseas exchanges, they'll see, they might wonder why rates are there, and that's, opportunity cost again. If someone's lending their Bitcoin, it comes with the cost that they can't sell it. And it also comes with credit risk, because they have to give their Bitcoin away potentially. And I think it's important. An important feature of the market is that a lot of institutions in the U.S. can't touch physical Bitcoin. They can only trade Bitcoin futures. So that's why the premium there exists. On overseas exchanges, you have retail investors who want leverage, so they trade futures on these overseas exchanges. So then a premium develops. And most of these investors are long only. They're not looking to short Bitcoin. So that's why there's the pricing is the way it is in the borrowing and lending markets.
All right, Uldis, once again, we can get some interesting interest rates on USDC on some stablecoins, and I'm gonna ask about it from Europe once again. We're not having this opportunity as investors coming from the cash environment. Do you think that's something we are going to see in 2021, or the fact that interest rates are just negatives makes us really not in a position where we will have a stable things popping up, and then maybe structure the same kind of markets with futures and sports in Europe?
Your audio was a bit breaking up, so I'm not sure if I got completely the question, but was the question about euro stable coins and futures based on euro, or what was the question?
Yeah, basically, let's start. Can you hear me now?
Yeah. So
Okay.
talking about,
do you see a stable coin in euro in 2020?
Yeah. So talking about stable coins, I think that the USD-based stable coins have established such a dominance currently on the market, and the way they are being transferred, and the ease of their usage is so high that I don't see the use case for a strong euro-based stablecoin. I mean, there are a couple out there. One of our partners, Eurostasis, came up with one a couple of years ago already, but I don't see it having, you know, such momentum as the USD-based ones, because, you know, what's the biggest strength of the stablecoin? It's, you know, this cross-border instant payments basically that they can do. That is one thing, and second thing is the kind of volatility safe haven in the crypto markets without going to the banking system, without going to fiat. So all of these things are perfectly covered by the USD coins, and I would see the only challenge coming from, you know, the central bank currencies there, because like for European market participant, I don't see any problem with using USDC or USDT. Why do I need a euro-based coin? I don't. The fact that, you know, over the few years there hasn't been strong euro coin, I think proves itself that it's just not demanded.
Yeah, I'd add to that actually. If you look at the on-chain data, you know, most Tether usage, for example, is in Asia Pacific, and you know, I think it's playing a role that people have wanted for a long time, which is to get access to US dollars outside of the US jurisdiction. And you know, if you're in Europe, you have euros that play that role, whereas in Asia you might want to go out of your local currency into dollars, especially if you can move them around as freely as you can. So yeah,
and it's also a lot easier to get into euros. It's a lot easier to work with euros. USD out of the US, you know, it's not easy to work. Even with Europe, it's not easy to work with, and not everybody has access to USD. So I think that really helps. Not sure if we want to start a bigger discussion about stable coins now, but yeah, no. It's
Yeah, I was going to add actually that on stable coins, that it's very ironic the kind of political action that's taking place in the US right now, because one thing that it does is it provides a way for people in emerging markets to access dollars, and extends the dollar's dominance in a way. So the fact that that the U.S. lawmakers want to limit stablecoin proliferation is very strange, because it actually helps support the currency. I think the other thing is that, again, just to talk about democratization, is that we really think that stablecoins are the way that a lot of people in the world will get access to, euros, dollars, pounds, or whatever, and to help them kind of fight off, devaluation of their currencies, and bring, because unless you have access, if you're wealthy and you have access to a private bank or something, or wealth manager, you can get a dollar account, but otherwise it's very difficult in those markets.
Thanks, David. We're close to the end, and I want to finish with one last question. I know in the audience we have like institutional investors that haven't made the move into crypto. Dan, how do you think about investing in the space? What should investors have exposure to, like on liquid assets, early stage tokens, venture equity? What do you tell them?
Yeah, it's a good question, and blockchain gives you the first chance to actually own pieces of the protocols themselves. When the rest of the protocols that make the internet happen in the early 90s, there's no way to buy a chunk of TCP/IP or SMTP. You just had to invest in venture. Here, obviously, you can invest in venture. You can invest in cool companies like Chainalysis, but you can also buy the tokens themselves, and I think it's important to have both. You should invest in tokens like Bitcoin, ETH, XRP, and then also invest in venture. Venture is obviously very illiquid, so you have to be able to lock the money up for a bit of time. And tokens have sometimes, Bitcoin has incredible liquidity, ICOs have 3 to 15 month liquidity, but a mix of all those I think is important.
As companies have been raising capital in 2020, I think. How would you respond to this one? Like how do you think institutional investors should make the move into crypto?
Was that a question just to me? Just the audio cut out. I'll take it anyway.
No, it was just to.
I guess, yeah. So
yeah,
I think
good.
we're definitely institutional investors. They're still going down the road very slowly about whether they want to custody it themselves. Like we get that perspective from Chainalysis because we obviously can provide the tools that they need to remain compliant when they custody it themselves. That's like a slower journey for them. But certainly that desire to hold it, that is like there at the moment. And also that desire to understand the data. Cryptocurrencies are unique in that you have all of the on-chain data, so you can really get and understand what's going on. And so we're seeing both, like I guess people like Grayscale are seeing huge funds flow in, people willing to pay a premium. That shows you that investor demand is there, but also great demand to actually understand the space, get the data, do the research.
Thanks, Philipp. Guys, it has been a real pleasure having this discussion with you. I learned a lot, and I'm sure people who are listening to us as well. We're out now, but if the audience has any question, you can reach out to our guest speakers, and have a great day. Thanks a lot. Merci beaucoup. Thanks.
Thank you.
Thank you.
Thank you. Thank you.
Great to see everybody.
Bye-bye. Bye-bye.
Bye.